Welcome back. I welcome you back. I welcome you to the channel. Thank you very much for tuning in. We are still busy with our Forex chart pattern secret or code to trading Forex chart pattern. We are on video number 3 in our series. So if you missed the previous 2 videos, I will put them in the description, or you can just check them in the channel. There's many other materials that you can find and that you can use to better your trading. Otherwise, my name is Muhammad. I also go by the name Proqnosiz. This is currency market execution, your channel to better improve your trading. So if you are into trading, if you're into forex trading, stock trading, if you are into any financial market and you want to continue to improve, you want to continue to learn, this is a channel for you. If it is your first time tuning in, please do hit that subscribe button so that you can be notified whenever we post a video. We do have cool giveaways, especially in the description, so never forget. In the previous video I did say it's like a treasure hunt, so never forget to check the description. We always have some good giveaways there. We have some coupons, we have some good stuff that you can find, so it always helps if you are the first person to come into the video, because some of the giveaways, they have a time limit or they are for a limited number. Otherwise, let us get started. We are going to be covering cup and handle. We're going to be breaking it down and getting into it, into how to trade it and all that. So without wasting any more time, let us get into it. The series is hot and I'm liking the comment section. I'm liking the feedback. I'm liking the feedback that you guys are giving. It means that this is adding value, because this channel is all about adding value to you. Always, we want to add value to you, and I want you, whenever you watch each and every video that you watch, that maybe after a week or 2 you can come back and say, yo, whatever that you're talking about helped me, it is actually true. Otherwise, let's get right into today's topic. Let's go. Welcome back. If you still did not subscribe, or if you are joining us for the first time or second time or third time, please hit that subscribe button so that you can be notified whenever we post a video. Or if you are enjoying this material, please hit that like button. It really helps with the YouTube algorithm. Otherwise, we have already established that there are 3 types of chart patterns. We have reversal patterns that we covered in the first video, which reverse the market, can reverse it either bullish or bearish. And we have continuation patterns, which is what we are covering today. We have already started on the video number 2, and this is just a continuation of that lesson on the continuation patterns. And then after that, we do have bilateral patterns, which are those patterns, as you can see here, which can either reverse the market or they can continue the trend. So what are continuation patterns, or what do we have in the continuation pattern category? We have continuation wedges, which we covered in the previous video, and we have cup and handle, which we are going to cover now, and you have bullish and or bearish rectangle or flex. I will explain. Some people separate them, I put them together. I will explain once we cover that why I do that. And then we have bullish and bearish pennant. So on this lesson, we are only going to cover cup and handle, and then on the next video we are going to do the bullish bearish rectangle and the bullish bearish pennant. If you're joining us for the first time, you'll understand that we really go deep and we break it down in a way that once you leave this channel, you understand. So sometimes it does take long, so that's why we are trying to not compress the quality, but compress the video. Hence why we are deciding to do them like this, where we separate the categories and where we separate them all together. Let us go in without wasting any more time. What is a cup and handle? I'm not talking about a normal cup of tea that you drink. We are still talking about the Forex chart patterns. So a cup and handle is a technical chart pattern that resembles a cup and a handle, where the cup is in the shape of a U and the handle has a slight downward drift. So how do you identify, or how does it look like in the actual chart? So this is a normal cup and handle. you will see here is the U type of shape, and then here is the handle, which is a slight downward drift, but it can look different also. We're still gonna cover different chart formations where you can see it. And then we have the inverse cup and handle, which is basically the same thing, just upside down, just vice versa. As you have seen, all patterns, they have an inverse pattern, so it is the way it is. So it is the same thing, same explanation, the same structure. So let us just go a little bit deeper. So the cup and handle pattern occurs in both small time frames, as you can see here. So you can see here, there you go, where we actually put a nice cup here, and then this is the U shape and this is the drift. So it can sometimes can go up and then you find it downward towards the end, but if you're looking at it in this way, it does resemble a cup. Actually, in this you can see the market was bearish and then it continued the bearish trend. So the cup and handle pattern occurs in both small time frames, a 1 minute chart, and in large time frames like daily, weekly, and monthly charts. It occurs when there is a price wave down followed by a stabilizing period, followed by a rally or approximately equal size to the prior decline. It creates a U shape or the cup in our cup and handle. The price then moves sideways or drift downwards within a channel that forms the handle. The handle may also take the form of a triangle. I'm going to explain and further break it down for you in the actual chart, but first let's just do these points to remember and make a mental note of these points. The handle needs to be smaller than the cup. So each and every pattern has to follow a certain rule or certain rules, and those rules must be achieved or obeyed for that pattern to be legit. So it's very, very important, as we have established and as we have been covering throughout the series. So the cup and handle is the same. It has rules that it abides by. So the handle needs to be smaller than the cup, and then the handle should not drop into the lower half of the cup, and ideally it should stay in the upper third. This is very important because, like I said, as you go in the charts, you will notice that, you know, like how sometimes the drawings of the patterns, they will look very perfect, they will look very neat, you know, but in the actual chart, like we established in the previous video, that patterns are hidden in plain sight. So they are always there. It's up to you or for you to have an idea or the knowledge of how to spot them and how to trade them, but they are always in the chart. So you have to know the rules for you to confirm the chart pattern, or what we can call the codes. So the handle should not drop into the lower half of the cup, and ideally it should stay in the upper third. If the handle is too deep and it erases most of the gains of the cup, then avoid trading that pattern. So the cup and handle pattern is considered to be a bullish continuation pattern. Therefore, identifying a prior uptrend is essential, but it can also be an inverse, meaning this rule, yes, it just says that it appears more often than none. It appears more often than none in a bullish trend as a continuation pattern, but it can appear also as an inverse, as a continuation pattern in the bearish trend. But I also want to add a side note that a cup and handle can also reverse the market. It does happen, but not so often. So it is best traded as a continuation pattern. So the cup should form more of a U shape as opposed to a V, with the high points on either side of the cup being approximately even, a neckline. So that's what actually that statement means. So the breakout signal can occur in different ways depending on the trader's preference. We'll cover that now. So some traders look at the resistance level taken from the horizontal between the highs of the cup. This is the neckline. Once this breaks that level, entry will be confirmed. Other traders use a break of the handle trend line as a long entry point. We're going to cover that just now. I'm going to show you what that statement means. Okay, fine. Remember what we've been talking about now. Once you look at this now without a cup that I put there, you will not even notice that this is a cup and handle formation. Let me show you. just wanted to prove to you something. Here is the market trending downward, and the prior trend was a bullish trend, and then it traded downward, and then it will find a slope here. It will find a slope here. I will explain the psychology behind the slope, and then the market will continue going up, and then here is your handle right here, and then your breakout to the upside. Let us just go into it. The cup and handle pattern is slightly more complex as opposed to other chart patterns, which can be tricky for some traders to identify, as we just established. Once you look at this, I did it on purpose to put the one that looks like this, because it doesn't give you that immediate thing that you see, but you can see how the handle is. It's not beyond the 50% of the cup, you know, and all the rules that we covered. It's not also giving you a V shape, it's giving you a U shape. So all the rules that we covered, they abide with this chart, so you can confirm that this is a bullish cup and handle pattern, and then you trade it the same way. Let's just go in. So trading with the cup and handle pattern differs slightly when using it to trade forex and equities. Why? The volume function is often used in stock trading, as a spike in volume indicates the breakout, which confirms the entry signal, because stocks are not so volatile as forex market, you know. So that's why, that's just what that statement trying to elaborate. So forex trading does not normally use this function, and instead involves other more conventional breakout confirmation methods, such as a break above the resistance, a break above what we call the neckline of the chart pattern. The rest of the process is the same when trading the cup and handle pattern. So most, as you've noticed, that in forex, most of the time, or most of these patterns, we are actually trading the breakout of the pattern. Some patterns, like what we've covered, like wedges, I did explain that you can trade within the pattern, but you are not actually trading the pattern. That is something else that you are trading. But the pattern trading, actually you are trading the breakout. You know, you are basically trading the breakout, but you can also trade within it. So that's what this statement is trying to explain. So what is the psychology behind the patterns? What is actually going on in the pattern? So as the downtrend starts to weaken, less sellers, the buyers start trying to take control from the bears, which means more bears, more bulls are coming in, by gradually accumulating long positions, bullish positions. So as they build up their positions, we start to see a wide U shape, the bottoming of the cup, or at the bottom of the cup, where bulls and bears are almost balanced. This suggests that the bears are no longer in control and the downtrend has been neutralized. In the final stage, where the handle forms, this is where the final battle of the bulls and bears take place. That's on the neckline. By this time, the bulls have the upper hand, as they have been accumulating positions during the cup formation, which in turn attracts more buyers. Once the last bears are killed or are taken out, or they've ran out of steam, bulls take full control and the explosive price breakout takes place. Let me explain. This is a bullish trend. This is the bullish trend, and then they reach a resistance or a point of correction, and what happens? You find bears coming in, because also the first candle, we've established this in our previous videos where we talk about when you are on a buy order, once you close that order automatically turns into a sell order. We've covered that already, so I'm not going to go deep in it. So this first candle may be from people taking their profits based on the previous resistance and their profit take levels. So once that happens, it pushes the market down. What happens? Some of the bears have been waiting at this resistance level also to place their sell orders, but you still have a lot of bulls in this trade. So As some bulls leave and more bears come in, it will push the market down. Now the selling pressure increase around here. You see there's another resistance point here, and then it will reach its bottom, where now the bears that have came in, maybe they were short, maybe they were few, they've started cashing out their profits also. But remember, there are still a lot of bulls in the market. I always said in the previous videos, it's always good to understand what is going on in the market. When you look at the charts, remember these are people and people taking decisions. Yes, we do have robots also, but basically that is what is happening. So you have to understand. So you will find that it will reach a level where both the bulls and the bears are no longer in control, where it will range. So now this is a zone of ranging. As you see here, this is a zone of ranging. The market is actually ranging, so there is no one in control here. The bulls are trying to take over and the bears are still trying to push the market down, but the bears are failing to push the market down because they have hit their floor, they have reached the bottom. So the market will range, and after ranging, the bulls will start taking control again. And then once also the bulls realize that the bears cannot break this level, the bulls start taking control. Nice thing is, as we covered in the previous videos about resistance and support, you can see this is also a strong point of support where the bears also failed to break this. So this is still the same region. So this is the psychology behind it. The bulls who also joined the trade here in this zone, who have been waiting for this price to come in, this is simple price action, they will come in again and push the market up. Now you find that there are also bears who are only selling at this level here. They will also try and come and push the market down. And what also, the bulls who have been cashing out at this level here, they will also cash out. Then you have that selling pressure coming in, which in turn forms your handle. Basically, that's what all chart patterns are formed based on the psychological effect of traders in the market. And as human beings, we tend to repeat the same. We have a repetitive nature. That is why forex patterns can be accurate, because as human beings, we have a repetitive nature. If something worked the last time, we will always do it again. So that's what happens here. That's how a forex chart pattern, stock patterns, or patterns in the market, they get formed. So because of the same thing that happened here, it's now happening here. But now look here, there's another support here which is quite strong, and now the bears fail to break it. So this symbolizes one thing: the bears are finished. They are finished, their steam is finished, and they don't have enough pressure or momentum to go down. The market will start pushing up, and as more bulls realize that the bears are finished, if you're looking at this chart, you can see that there is no longer a bearish power. The bulls come in to push the market further up and then to test the previous resistance. Once this resistance is broken, remember this is a region, it's not a simple line. So once it is broken, it becomes support, which gives the bulls more power and pressure to push the market up. That's why you find this breakout here, and then this chart still continue. It's going to test here and it's going to further go up, because now this becomes a very strong support. It will take bears quite too much for them to break this level of support. So that's basically the psychology of it. That's just what it's simple as that. That is the psychology of a cup and handle. So once you see this in the market, you already know what traders are thinking. You already know what is going on. You would not want to be a bear, so you want to be a bull, because that is where the trend and that is where the market is going. So how would you trade this type of market? Simple. There is a strong bullish push going up. So here, as we explained in the previous slide, that this support here is quite strong. This is another chart. Look here, this support here is here, it's a previous resistance here, which was quite strong, but it was broken by this strong candle. So you can bet on this, that this support here, because it was a strong resistance, it will be now a strong support to hold. So your stop loss can be below this strong support, and then you can take your first target here. This is for aggressive trading. So if you're an aggressive trader, you can take your entry on this zone here after the breakout of this small channel. After that, wait for the candle that breaks out. Make sure that it breaks out above the channel, and then you can come in. That's for aggressive trading. But if you want to be a safe trader, you can rather go for a 1-to-1 ratio and then wait for the neckline to be broken. Once the neckline is broken, then you enter your trade. You go for target 2. This pattern, actually, unlike the previous pattern, it can continue. You remember the previous patterns, we knew that we could check the range here of how long the pattern will be. But as we established in the previous videos, Forex chart patterns will give you 1-to-1 ratio or 1-to-2, which is risk 1 and the reward is 2. So that's what happens most of the time. If you get a 1-to-2, it's a very good setup for chart patterns. So I've advised that if you want to go for maybe a 1-to-3 ratio, rather lock your profit after the first target is achieved. That's if you are going for 1-to-3, so that if there is a reversal, you'll still be safe. Like here, this would be your 1-to-1 ratio. If you want to go for the 1-to-2, it will still be here. So what would happen here if you would have locked your profit on this level? That's if you had your entry here. But if you're an aggressive trader and you entered here, and remember that this channel here will not always be like this. Most of the time it can even face up here, so it will not sometimes give you an opportunity to have this early trade into the market. So this is just an example of when the chart or the handle is in this way. The handle sometimes face down and it can be here, so that will give you a nice entry below the neckline. But I always don't advise going below the neckline, because like I said, a cup and handle can also be a reversal, but you know, not always, but there's a chance that it can also be a reversal. Ne? So let us go into the next example. As you see here, also like what I was explaining, in this zone here, it did not give you a chance to have your first entry, you know, your early or your aggressive entry. That's what I mean. So you will look here, you can have your stop loss here just below the latest support, because I can say this support here is the same support here. It is still strong. And then I promise you, if you look in your chart, you will also find a similar thing. Always compare the support. We always use the latest one, but compare with the previous ones also to see how strong it is. It never broke here. Yes, it broke here, but once it became a resistance, and then it broke to re-establish itself, and then it stood, you know. So you can be quite sure that this will be strong. If you want to say, no, I want to stretch mine, you can stretch it to here, but then it's going to affect your risk reward ratio. So you can have it here, and then this one gives you an entry on the neckline. Once the neckline is broken, you place your entry, then you have two targets like what you explained. You have target 1 and target 2. Target 1 here, it will be your 1-to-1 ratio, and then this one here will be a 1-to-2 ratio. So if I said you're going for 1-to-2, you can always lock at target 1 if you're a medium risk. If you don't mind risk, once you're on target 1, you can always move your stop loss to your entry level here, so that you are entered a risk-free trade. And if you would have done that, you realize that you would have took all your profits till target 2. But if you lock here at target 1, you might have been stopped out or trailed stop right here at this point before the market shoots up. It's just up to you and to your risk appetite. We all don't risk the same. So basically, that's how you enter or exit the trade in the continuation pattern for the cup and handle. And for the inverse cup and handle, it is exactly the same. Matter of fact, then you will know that you are looking at a resistance, not support anymore. It's just the same pattern, but it's upside down. This example here, it's some people, you know, like for me, I always want to say, for this cup and handle, always try to aim for a 1-to-1 ratio. If you can go for 1-to-2, yes, go to 1-to-2. But most people believe that the depth of the cup is the same output, or the breakout will be the same depth of the cup, like we've seen with previous patterns. So this is the inverse, né? So this is the inverse cup and handle. Like I said, the same strategy that you've put it, and the psychology is also the same. It's just vice versa. So I just want to show you the target. If you are an aggressive trader, you can enter after the breakout here, knowing that your target 1 will be here and your target 2 will be here. If you are not an aggressive trader, you can enter on this zone here after the neckline is broken, and then you go, because after the neckline is broken, the odds and the chances of it reversing are very minimum. Unlike here, it can reverse again and then go up again, so you don't want to be stopped. And the stop loss will be the same. In this point, it will be the previous resistance, but in the normal cup and handle, it will be the previous strong support. So the same thing, it is just being done vice versa. So let us recap quickly and then just cover some few stuff. And as you've seen here, the same thing. You look here, it's a triangle, like what you said. So it is a triangle, and this one here will not give you an opportunity to have the early entry. That's what I meant on the previous. And look here also, if you were gonna have an early entry here, depending on where your stop loss is, if your stop loss is going to be here, you are still going to be safe. But what I meant is, it went here, hit the neckline, and started ranging. Sometimes it can even hit the neckline and push down, and then go here, push down and take you out, take your stop loss, and then continue going up. So that's what I meant. So there's a risk if you're going to do an early entry or an aggressive entry. That's a risk that you are taking. So the neckline is safer, because once it's broken, the neckline becomes your support, which becomes your safety in case the market reverse again, that it will hit that support and bounce off and go up, né? So let us just do the recap. So the cup is usually U-shaped, as you see here, and may be considered as a rounding bottom. We already established that rounding where the indecision, with almost equal highs on the either side, almost equal highs, which is your neckline. However, a V-shaped cup also qualifies as a cup and handle pattern, but the conviction is higher in U-shape due to the consolidation at the bottom. I said if it's V, most of the time ignore it. But why? Because it's more riskier, you know. So if it's a U, you know that the odds, because I always tell people that the nice thing about, or the difference between Forex and going to a casino is, in a casino the house always wins because they set all the rules, but in Forex you set all the rules. So you must always make sure that the odds are in your favor when you open a trade, so you have more chances of winning when you enter the trade. That's what I mean. So the V only invalidates it because of the chances of it failing are much higher than when it is a U. Basically, I just waited till this point for me to explain it fully after I already showed you, and for you to also understand the psychology behind, because the sharp V means that consolidation never tired the bears, you know, they didn't tire, so that consolidation will tire them out, and then you will know that they, you know, once you reach the neckline, there's not enough bears to further reverse the market. Basically, the psychology behind it. So the handle is usually the pullback from the higher end of the cup, which may be rounding, triangle, or a descending channel. Let me repeat that. The handle is usually the pullback from the higher end of the cup, which may be rounding, triangle, or a descending channel. Usually the pullback is about 1/3 of the size of the prior advance. Here it is a triangle, and then on the previous slide we saw a channel, and then you know, sometimes on that other first example it was rounding. So it can be in different, the handle can come up in different shapes. That is why, like I said, sometimes it will not give you that opportunity to go for an early entry. So the cup and handle is a chart pattern which has a bullish potential. The pattern consists of what? Two elements. What are those two elements? The cup, bearish price action, which gradually changes direction. This is the bearish price action which gradually changes direction. And the handle, bearish price action, which starts right after the cup and ends around the midpoint of the cup. This is what that point is talking about. So the two elements create a pattern which resembles a cup with a handle on the chart. The cup with handle patterns has its bearish equivalent, and it is referred to as an inverted cup and handle formation. The cup with handle confirmation comes when the price breaks out of the handle. If the pattern is bullish, you should wait for bullish confirmation and you should trade the pattern long. To trade the pattern successfully, you could implement the following rules. These are additions. So okay, this one is vice versa for the bearish. So if the pattern is bullish, buy when the price breaks the handle upwards, like what we did. And this is an example of a bearish one we already established, and we already did that. It was for the statement. Né? And then if the pattern is bearish, sell when the price breaks the handle downwards. This is just for people who don't want to take that early risk like I would most of the time, depending, because what will give you that opportunity is the handle. You see, this handle gives you an opportunity to go for an early trade, because you can also set your target here in your neckline to be your target. So but some, as we established, can be a triangle, which does not give you an opportunity to go for an early trade. So here is your nice cup and handle that now left the chart. So put a stop loss. How would you put your stop loss? Below the handle if the pattern is bullish, and above the handle if the pattern is bearish. So you take profit using the two target rule that I've explained in the previous chart, or you can use a trailing stop. So target 1 equals to the vertical size of the handle applied at the moment of the breakout through the handle, and target 2 equals the vertical size of the cup applied at the moment of the breakout through the handle. And this brings us to the end of our wonderful lesson. If you enjoyed this lesson, please do hit that like. It helps us a lot when it comes to YouTube algorithm, so that YouTube can also know that you liked this video. If you want to add anything, you can hit us in the comment section and then tell us what you think. Also, if you enjoy this type of stuff and you obviously watched till this point, it means that you enjoyed it. So hit the subscribe button so that whenever we post a video like this, you can always get a notification, and then you can always be the first one. Don't forget to check the description for giveaways and the stuff that we put in there that you can also save a lot of things. Let us just check what we're going to be covering next. We're going to be looking at the bullish and bearish rectangles, and then we are going to be looking at bullish and bearish pennants, and then after that we are going to look at bilateral patterns. You're going to be looking at bilateral patterns. Otherwise, do not forget to check our website. And then we do have some cool stuff there. If you enjoy this type of stuff, we have even in-depth courses where we go in. If you want to learn how to trade, we do have some in-depth courses, and we do have some advanced course. So just imagine, think about it. If you can do this type of stuff for free here for you on YouTube, what information are we giving in our courses? If you want to find out, enroll in one of our courses, advanced or beginner courses, up to you. And if you say, you know what, I don't want to trade, I don't want to go through the process of learning how to trade, understanding patterns, how they work, like I don't want to do that, but I want to make money, what can you do? You can copy trade with us. You just copy our trades. We trade Monday to Friday. We have all different types of packages and groups where you can meet like-minded people and chat with them. We have fundamental packages, we have technical packages, we have a fundamental package, silver package, gold package, and the premium packages. All different packages to meet you where you want. So there is no excuse. Otherwise, just check out our store in our website. Also, we do have some cool stuff. We also have a book, Trade Forex, the Wolf Way, which is a beginner guide book which covers most of the stuff, which includes risk management and traders psychology. So you always need to know and understand what is happening. That is how I am successful in trading, because of I understood at an early age early age, I mean, in my trading, of always understanding what is going on in the market. It helps you a lot and it gives you an advantage for you to be able to understand what the people are doing and what they are thinking and what is big money also. We're going to cover that when we talk about big money, what big money is also doing in the market. Otherwise, my name is Mokhomutsi. I go also by the name Proqnosiz, or you can call me Alpha Wolf Forex. I am glad that you enjoyed this session. Please do not forget to check us out in our social media. We are also in Instagram, we're also in Facebook, and we're also in Telegram. We do have a free, if you say, okay fine, I want to test out your systems, I want to test out your packages, but I'm not ready yet, you can always join our Telegram public group. It's free. We do have signals. Matter of fact, just now, previously we did a signal, actually not previously, let me say yesterday, we had a very brilliant signal that we posted in the public group, and it made over 3,000 points for free. So imagine what people who are in paid groups are getting. So my name is Mokhomutsi. I go by the name Proqnosiz. I also go by the name Alpha Wolf Forex. If you did enjoy this video, do not forget to hit that like and hit that subscribe. I will meet you just now with another video. Before you forget, watch these two videos, one here and one here, one here. You need them.